Hello budgetaholics, my name is everyone and welcome to Paris. Monday is the first trading day of February, and in today's video we're going to go over the 5 best dividend stocks to buy in February and hold for future passive income. Is there anything better than sleeping, chilling, or having fun and being paid while doing nothing? If you don't think there is, dividend stocks are the right investment for you. And the first thing to do if you want to be a successful dividend investor and enjoy the comfort of passive income is smash that like button and hit the subscribe button and the notification bell so you can stay updated with the best bargains for dividend stocks. Without further ado, let's jump into the list. When choosing which dividend stock to buy, first you need to decide if this is a good company or not. After stocks pass this first screening, we then look at 6 different metrics. If a company fits the criteria for those metrics, it gets into the list. Starting off with number 5, Broadcom Inc. Listed in the Nasdaq with ticker symbol AVGO. Broadcom is a technology company. They design, develop and supply a range of semiconductor and infrastructure software solutions. They operate in 2 segments, the first being semiconductors for retail devices and the other sector is infrastructure software solutions, which is mumbo jumbo talk for corporate software, cloud computing, and network services. They manage the data transmission between data centers, and they provide products or services for companies such as IBM. But you might be more familiar with their retail products as they provide semiconductors for Huawei, Apple, and Samsung smartphones. The first ratio we look at is the P/E ratio, which is defined as the price of a stock over the earnings per share. Broadcom is currently trading at $462 per share, with a 12-month trailing P/E ratio of 73.3 and a forward P/E ratio of 17.56. The trailing P/E ratio tracks the price-to-earnings ratio for the previous 12 months, while the forward P/E ratio takes into account projected future earnings. They have a payout ratio, and this is the alarming metric, of 205%, meaning that in order to pay dividends to investors, they needed to use past profits. However, these metrics are expected to change as both Samsung and Apple have come with new iPhones requiring new semiconductors. They have a 5-year annualized dividend growth rate, which is the growth rate of their dividend over the past 5 years, of 714%. And they've been growing their dividend for 9 consecutive years. And the fact that they chose to keep paying a dividend over the pandemic shows me a company that is committed to consistently paying their investors. Finally, they have a pretty decent dividend yield of 3.10%. Finally, they have a pretty decent dividend yield of 3.10% as they're currently paying a dividend rate of $14.40. According to Yahoo Finance, they have a recommendation rating of buy, with the analyst's price target being $474, which is $10 above what the stock is currently trading at. Number 4 on the list is Digital Realty Trust, trading in the New York Stock Exchange with ticker symbol DLR. Digital Realty Trust is a REIT, although somewhat unconventional. A REIT is a real estate trust which manages different properties across the globe, and they are required by law to pay their shareholders at least 90% of their profits. However, Digital Realty Trust, instead of owning apartment buildings or shopping malls, is in the business of acquiring, developing, and operating data centers. They provide data center co-location and interconnection solutions, meaning that they connect data centers which are in the same area or data centers which are in different areas for customers across a wide range of industries, ranging from social networking and communications to financial services, healthcare, manufacturing, energy, and consumer products. They have 225 data centers, of which 147 are in the United States, 41 are in Europe, 19 are in Latin America, 10 are in Asia, and 5 are located in Australia, while 3 are located in Canada. They have developed a platform called Platform Digital through which they market their co-location and interlocation services. Recently, they were chosen to take care of the Pace Cable in France. The Pace Cable is a submarine cable 15,000 kilometers long and constitutes a gateway from Pakistan and East Africa connecting Europe. It passes through various countries such as Kenya, Somalia, Pakistan, Egypt, Cyprus, leading to France. This is a huge deal for DLR as they cement their standing in Europe, and it indicates how their business model includes healthy acquisitions, good fundamentals, and a great potential for expansion. Looking at their financials, the company is currently trading at $145.85. They have a slightly high P/E ratio of 67.09 and a payout ratio of 60%. 67.37, which is just above the 60% limit we're usually looking at. However, their business model looks to have great potential as data centers will be in high demand globally. They have a 5-year annualized dividend growth rate of 31.76%, and they've been growing their dividend for 12 years. Their current dividend yield is 3.07%, with the stock paying just shy of $4.5 per share. They have a recommendation rating of buy, with the stock being $20 below the average analyst's price target of $165 per share. At number 3, we have a Warren Buffett classic, the Coca-Cola company, trading in the New York Stock Exchange with ticker symbol KO. Coca-Cola is a company that needs no introduction. Their main moneymaker is the Coke brand, but they own several other brands such as the Sprite, Fanta, and Schweppes fizzy drinks, Innocent and Simply juices, water brands such as Dasani and Smart Water, and coffee and tea brands such as Costa Coffee and Fuse Tea. The stock is currently trading at $49 per share with a PE ratio of 25.54. They have a payout ratio of 84.46%, which, as I've said before, it would be alarming for any other brand, but the company is expected to bounce back as lockdowns and restrictions start getting lifted. They have a 5-year annualized dividend growth rate of 24.24%, and they're the only dividend king on the list, as they've been increasing their dividend for 57 consecutive years. They currently have a yield of 3.38%, with the stock paying a dividend rate of $1.64. Finally, they have a recommendation rating of buy, with the stock trading below the analyst's average price target of $57 per share. If you have no idea what dividend stocks are, check out this video, for which I'll leave a link here and down in the description, where I explain what dividend stocks are and what are the advantages owning dividend stocks over the long run. At number 3, we have Cisco, trading in the Nasdaq with ticker symbol CSCO. Cisco is another technology company mainly marketing their products to companies. They have 3 main business segments. The first is infrastructure platforms, which includes data centers and other network products that make up 75% of their revenue. Their second product category is application products, consisting of software-related products that utilize the infrastructure and data center platforms, which are their primary product line. An example of an application product is WebEx, which is one of the competitors of Zoom and Microsoft Teams. This category makes up for 25% of their revenue, and in contrast to their infrastructure platforms, the revenue from this category is expected to grow. The reason being that they are focusing on subscription-based products, as many other tech companies are doing, which will firstly create a stable stream of revenue and secondly allow them to expand their ecosystem. Finally, they have a cybersecurity product category making up 18% of the revenue, which provides threat management products and web security products for companies. Their main product category, i.e. infrastructure, is expected to go down, while the other 2 are expected to increase. The net effect on the revenue will depend on how much these categories grow or shrink. Cisco is currently trading at $45.07 per share. They have a P/E ratio of 18.32. They have a payout ratio of 57.89%, just below the upper limit of 60% we usually set. They have a 5-year annualized dividend growth rate of 74.39%, and they've been growing their dividends for 7 years. They have a current dividend yield of 3.20%, with the stock paying $1.44 per share. They have a recommendation rating of buy, as the stock is trading $5 below the analyst's average price target of $49 per share. Finally, at number 1, we have Verizon Communications, listed in the New York Stock Exchange with ticker symbol VZ. In last month's dividend list, I mentioned AT&T, and in a poll I made on Instagram about which stock is going to win the 5G race, most of you voted in favor of AT&T. However, both of them are great companies and there is no reason you shouldn't invest in both. Verizon Communications is a holding company. Through its subsidiaries, it provides communication, information, and entertainment services to businesses, corporations, and government agencies. Its 3 reportable segments are Verizon Consumers Group, the Verizon Business Group, and Verizon Media. Its consumer segment provides wireless and wireline communication services, meaning that they're both an internet service provider, focusing on a fiber optic network, as well as a mobile data provider now trying to win the 5G race. Its business segment provides mostly data and network communication services, including local and long-distance voice servers and network access to deliver various Internet of Things products and services. Through the Verizon Business Group, they service both corporate clients as well as government agencies. Lastly, they developed the Verizon Media Group by acquiring different companies such as AOL and Yahoo. Verizon is currently trading at $56.60 per share with a PE ratio of 12.80. They have a payout ratio of 55.94%, which is within the range of 30 to 60% we're usually looking for. They have a 5-year annualized dividend growth rate of 13.20%, and they've been growing their dividend for 13 consecutive years. Their current dividend yield is 4.3% with a dividend rate of $2.51 per share. Lastly, they have a recommendation rating of buy as the company is trading below the analyst's average price target of $61.20 per share. This was my list of the 5 best dividend stocks to buy in February 2021. I'm making all my trades through Revolut, which still allows the purchase of GameStop. And you can sign up using the link below, also getting a free high interest rate savings account. And at this point, I'll shamelessly also plug in BlockFi, which is a high interest rate savings account for cryptocurrencies. You can also sign up using the link below, and if you do, you can earn up to $250 plus 8.6% APY on your crypto deposits. If you enjoyed this list, please hit the like and subscribe buttons as this helps me immensely with the YouTube algorithm. And until we meet again, don't stop investing.